Joining us from the Chicago Board Options Exchange, Pat Kernan of Cardinal Capital Management. He trades S&P 500 options. Plus, Jason Huntley, Chief Investment Officer of the Mars Hill Global Relative Value ETF. It's a long-short fund. He's been leading on the short side, and he joins us from Denver, Colorado. So we are across the nation on this Monday. Jason, I want to kick it off with you. So you're leading on the short side. How come?
Yeah, we're still managing risk around these extreme price levels. Over the last couple of weeks, we've seen a lot of consolidation and resistance up here at the top end of the S&P 500, and part of our conviction has been that markets are mispricing risk, and we think managing that risk to the downside is more prudent at these levels. Hey,
Pat, you trade the S&P 500 options. What about you? Do you think there's a lot of risk out there?
Well, yeah, I definitely think once you get to the end of a range, in particular right now we're towards the higher end of a range. We haven't seen these levels since this past spring. I think you definitely throw in a lot more risk. People come in, there's the fear that we could have a pullback. People start to trade options and try and do hedge their positions if that were to happen.
Well, what do you guys make of some of the wrangling we were having over currencies and what we got out of the G20 this week? And Jason, you take that. I mean, how significant is that, and the expectations really on top of that of QE, more QE coming this way? How does that play into kind of your market outlook at this point?
Well, I think today was pretty much to be expected based on the rhetoric coming out of Korea over the weekend, where not a lot happened really. And the trade for the last 60 days has been dollar down, risk assets up. So we're seeing a continuation of that trend. I think you have near-term catalysts still on the horizon with the elections and the actual announcement by Bernanke next week, whereas the markets have been trading on the speculation of what might be occurring. Now it's sort of game time in terms of actually getting the real answer.
You know, Jason, you mentioned two possible catalysts being Ben Bernanke next week and those near-term elections. Let's talk about the elections. A lot of folks are saying gridlock, that'll be good for the markets. You agree?
I would agree. I think that being already priced into the market as well. But I think it introduces the notion of some austerity and fiscal discipline into some of the fiscal stimulus plans and bills that have been passed over the last couple of years. And I think that's what the currency markets are looking for, is potential strength for the U.S. dollar at these levels.
Jason, let me ask you, I mean, we heard from Dean Mackey from Barclays today that he thinks the consumer is really starting to pick up the baton. That's what we've all been waiting for. We also saw home sales, existing home sales rise 10%. That's the highest level on record. Do you think that the consumer could be coming back in a stronger way than most have been expecting?
I don't at all. I think the consumer and American households are firmly gripped in deleveraging right now and trying to repair their balance sheets. Of course, they're going to spend. There's a lot of things they still need to spend money on, but it's not the discretionary spending, all the real goods that people are looking to in terms of the upcoming holiday season and so forth. It's still retrenchment mode for most people in America, and I don't think that bodes well for consumer spending over the near term.
Hey, Jason, if I'm hearing you right, this is Adam, by the way. It sounds like there's a disconnect in your mind between the inflation in the commodity world and simply a lack of inflation on the consumer side. Is that right?
That is right. I think when you talk about inflation, it's very vital that you differentiate if you're talking about asset price inflation versus consumer price inflation. And obviously, with the hurting economy in the U.S., we don't need consumer price inflation. That would be an additional strain and headwind. But clearly, the Fed is after asset price reflation as a means to solve some of this recovery slowdown.
Hey, Pat, it's Dominic here. Speaking of this whole inflation kind of talk that we've been kind of engaging in, how surprising was the Treasury's auction today? A lot of people have been expecting a negative yield, but to actually see that on the headline, does that play into asset valuations? Are people in fact going to expect inflation now because of quantitative easing?
Well, actually, honestly, I think we were kind of expecting it. The Bloomberg survey came in right expected on that. So it was actually, for us, it was kind of baked into the cake already. So we were expecting it. As it came out, we did see a little bit of a jump in or a little bumpiness in the equity markets. But really, there wasn't. It was still kind of this like low volume drift higher trade that we've been seeing for the last several sessions. I know we sold off here in the last few minutes of trading. But it's one of those things right now. It seems like the trade is we were kind of slowly grinding higher towards the highs of the spring, and everyone's kind of waiting to see what happens with the elections.
All right, so you're watching the elections, Pat. What about, though, what happens at the Fed meeting next week and Ben Bernanke? If we get that QE2, as everyone expects, more quantitative easing, do we start to kind of sell on the news at that point?
Well, you know, they've said over and over that it's coming. I guess it's going to be it's going to be, you know, I guess how much and when. I really think right now this market's going to be fairly slow until the elections. We've kind of built up to the Fed meetings over the past couple months, and they've kind of been non-events. I think that's what we're going to look at for this one coming up. And really, it's going to see if we wind up with gridlock as far as the House and Senate are concerned.
Jason, what do you expect? Because if the Fed does come out with quantitative easing, and if it's massive, the market will probably be happy short term. But, going by your sentiment about the consumer, that they're still retrenching, and if the Fed drives up inflation, that could really hurt the economy, couldn't it?
Yeah, and I think the market's already expecting a massive announcement by the Fed next week. So our expectation is for disappointment, that we're not going to get the size and the immediacy of implementation that the markets and risk assets are already pricing in.
Hey, Jason, it's Julie here. Talking about the consumer, though, I mean, some of the more recent numbers that we've seen on the consumer front, retail sales included, have been a little bit better. So what happens when we get past the Fed, when we get past elections, and look towards the holiday season? I mean, is there any room for positive surprise there?
I don't think there is. I think the upcoming holiday season is going to disappoint. There's been a lot of hype. Especially talk over all the hiring from some of the big retail chains. But as I said before, really the American household is in balance sheet repair mode and rising savings, increasing their savings. And I think discretionary spending is going to be cut even heading into the holiday season coming up.
Hey, guys, I want to go back to QE2 because, Jason, something in my notes about your thinking about QE2 kind of caught my attention. I mean, at what point do we kind of get our head around the idea that, we don't necessarily want consumers out there spending more money than they should be? I mean, that's what kind of got us into this situation from one aspect to begin with. So when does the market start to realize that, and that maybe QE2 isn't such a good thing?
Well, I think it could come sooner than many people are expecting right now. But I think the Fed themselves have even indicated that they're not sure to what degree QE2 is going to work and make an impact on their primary objectives, which is to stimulate the jobs market and thereby help improve the housing market, both of which are still languishing, which also feeds into the consumer spending thesis. But again, I think near term markets are probably set up for more disappointment than positive surprise.
Hey, Pat, it's Adam. You're a trader down in the pits. I want to know what the trade is. If, in fact, QE2 is already priced in, if a Republican victory in the House is already priced in, what's your trade right now for the next week?
Well, for the next week, we're kind of we're taking a more of a neutral stance to a small grind up in the overall market, and then with the options market, we're expecting to see volatility kind of trail off a little bit, meaning it's going to go a little bit lower over the next week. But I tend to agree with Jason that over the longer term, especially going through the end of this year, have more of a bearish opinion that right now what we're feeling is that if we're going to have a move, if we're going to break out of this range, my opinion is that it'll be sharper to the downside than it would be to the upside.
Pat, how much more sharper to the downside? Give me some idea. Are you talking a couple of percentage points or something more significant?
Well, I mean, I wouldn't be surprised to see us have at least a 5% retracement, but I mean, that's just my personal opinion. It's not exactly what I do for a living as much as Jason, but we're definitely in agreement that basically we've seen this market slowly grind higher and grind higher without any speed bumps, really. We haven't had a significant pullback. The one thing I could definitely see is that for that day, if a pullback does come, that it could be kind of sharp and could be kind of dramatic.
Jason, got 10 seconds here. Could we see a 5% pullback on the equity side of things?
Yeah, I think we broke out of the upside of the range around 1130 on the S&P 500, and I'd say that's probably new support now, which would be a 5-6% pullback from where we are currently.
All right, guys, we're going to leave it there. Thank you so much. We've got Pat Kernan of Cardinal Capital Management trading the S&P 500 options. Jason Huntley, Chief Investment Officer. You bet, guys. Thanks. Chief Investment Officer of the Mars Hill Global Relative Value ETF.